Shopify stock has had a massive sell-off of 82% over the course of 2022, but has now actually rebounded about 60%, putting them at a market cap of about 54 billion US dollars, and of course an undefined PE because they are not profitable at this current point in time. So now that they've reported their Q4 earnings, it's time for us to make an analysis to figure out whether Shopify is a speculative buy, sell, or hold at these levels. So make sure to stick around to the end of the video as we'll answer all your questions and more. How's it going? Welcome to Everything Investing. I hope you're having a great day. As always, today we are going to look at this business's fundamentals. Then we're going to take that in conjunction with our trajectory of this business, make an evaluation here to see at what points we should be interested in buying this business. And if you do like this type of content, make sure to smash that like button. Also subscribe as it really helps out the channel. And lastly, also make sure to comment your thoughts on the analysis in the comment section below. With all that out of the way, let's jump into the analysis. All right, and let's dive into Shopify's Q4 earnings for this year. All right, let's look at this. $5.6 billion worth in revenues for the full year. That's a 21% increase on a year-over-year basis. Very strong numbers for a business that is down, 82% over the last year. That brings them to a total of $650 billion worth of commerce since their inception. Definitely on its way to reach that $1 trillion figure. Massive numbers there. They say they make up about 10% of the US e-commerce market and that they're expecting further penetration into the future. Again, when you think of how much money is spent on a yearly basis in US e-commerce, those are some very important numbers. That puts them at 561 million unique online shoppers across 175 different countries. Now, notice one thing here. While there's lots of good things going on, especially in the top line, they don't mention here, at least for the highlights in 2022, the bottom line. We're going to talk more about that in just a second. First, when we take a look at this chart here from Main Street Financial Data, the first link in the description, and honestly, an amazing investment resource for us value investors to break down key fundamental data. We can look here at the gross merchandise volume and gross payment volumes here for Shopify. Those have been growing year over year, quarter over quarter, despite the slowdowns there in 2019, which is definitely something that can attract investors when they see growth like this. That bleeds into their revenue by segment. Again, another chart here from Main Street, which outlines the subscription revenue growth that we've seen, but also the merchant solution growth, which really is leading the way, which ultimately allows them to now produce about $109 million on a monthly basis. That's recurring revenue, that is, right? A 7% increase from last year's results. And again, is leading into higher levels of penetration here. And, an important part of this business and the growth prospect here is that they are looking to expand their global geographic reach, especially with their newer business offerings that they're looking to bring to more countries. But while all the growth prospects look good, we have to always look down at the fundamentals here. So if we look at this on a yearly basis here, looking at this year's results, again, let's just call it $6 billion worth in revenues from a comprehensive perspective. Cost of revenues, at least for subscriptions, not a lot of cost there on the $1.5 billion in revenues. But when we get down here to our merchant solutions, these costs have increased substantially, on that $4 billion worth of revenues. So now we're looking at gross profit of $2.7 billion. That is still an increase from that $2.5 billion figure last year, but it's just not that monumental increase that you would expect based on the revenue growth. Simply because when we look down here at our operating expenses, look at this, guys. Not only are their costs of revenue growing, but look at the operating expenses, right? Sales and marketing has increased up to $1.2 billion worth. Research and development, $1.5 billion worth. So right there, all your gross profits gone right away. Then we have general and admin, $700 million. Transaction and loan losses, another $130. So altogether, $3.5 billion worth in total operating expenses. That leads to a drawdown of $820 million on an income from operations perspective. Last year, they were able to squeak out a bit of profits, but this year, definitely trending in the wrong direction. When we look at this from a cash flow perspective, $97 million was actually produced from operating the business. That is cash I'm talking about here. When you deduct for their capex, they don't really spend too much. This is free cash flows of about $90 million. They're not really going to do much with those $90 million. I can let you know right now. The liquidity position is very strong. $5 billion of cash on that balance sheet, which if you look down here, they have about almost $1 billion worth of convertible senior notes. So keep an eye on that. Because right now, especially with businesses that are trying to navigate profitability and transition there, a lot of times they do have to do things like dilute shareholders, take on more debt to grow, things like that. So just keep an eye on that, especially if you are interested in investing in this business. Now, when we get down here to this Main Street chart, we can see again how they have transitioned over the last few years with regards to revenues, translating all the way down to their operating income and the bottom line. Well, as you can see for 2022, definitely trending in the opposite direction, but it's obviously something they've been challenged with over the past few years as well. with 2021 being a strong year for them. And if we look at what we can expect into the future, they do expect further impacts from their compensation leveling exercise. What this is they change their overall compensation system to be better aligned with the market, is what they're saying. And so that's going to lead to further expenses into 2023. Same thing with their expense run rate for Shopify's fulfillment network. Those are also going to create a headwind to gross margin and lead to higher levels of operating expenses, not what you'd want to see here as a potential investor, because they're alluding to further challenges into the future, less profits. All right. If we look at what they're expecting for Q1 of 2023, at least, they're still expecting to see that revenue expansion. But again, once we get down here to our operating expenses, those are expected to expand as well. And altogether, you can expect for Q1 of 2023 to be more aligned with Q4 of 2022. Now, when we get over here to our calculator, and given their negative operating income figures, if we do expect that they can achieve into the future of just, about $1 billion worth of operating income, let's just say a few years out from now, with a 10% required return, expecting that they don't pay a dividend at that point, and we only expect them to grow at about 8% for the next decade on a 40 PE, let's assume, the stock would be fairly valued for a 10% return at about a $34 price rating. The stock is actually currently at $43 per share. So even if they were to be profitable, they'd still be overvalued at this current point in time, at least from a margin of safety perspective. Now, let's assume things actually do get better for Shopify. Let's assume they can actually start growing. If we look at this from a historical perspective, they were able to grow at some high numbers. So if we expect just 18% growth over the next 5 years, that drops down to about 12% growth for the 5 to 10 years after that. On a 45 PE, the stock could actually be fairly valued at about $70 per share. So some upside from these levels. Now, in the very worst case scenario, where we see more of the same, like they're alluding to for the next 5 years, though, on a negative 1% growth rate, that finally stabilizes out at about a 7% growth rate once they get everything going for them and they're able to shift into profitability. Let's assume this is trading at a 35p at that standpoint. The business would actually only be fairly valued at about $18 per share. Now, take these results with a grain of salt, because if they are able to transition into profitability here, $1.2 billion is obviously not going to be the be all end all. If we assume that on a yearly basis, they'll be able to achieve at some point $4 billion worth of operating income. Again, that is on an annual basis, and we assume the exact same growth metrics. You can see how this has impacted these valuations here, and the stock would absolutely cannon up in the best case scenario here to $250 per share. So let's talk a little bit about the pros. Okay, they have a very large and loyal consumer base, massive business, 10% of the market share in the US, and that's expected to continue to grow. That should be something that does attract investors. They're also focused on expanding those numbers internationally, especially, which of course will have further improvements on their margins. Lastly here, they have mentioned that they're focused on increasing their subscription fees into the future, which will obviously fuel their revenue growth into the future, which should actually be more beneficial for their bottom line and probably improve their margins to a degree. Now, let's talk about the cons. Okay, they have had challenges with their profitability, obviously something that the management definitely wants to work towards, but from what they're saying, they're expecting that the profits will not be coming in 2023, maybe later 2024, 2025. You can expect that shift there, but at least for early 2023, don't expect profits from this business, and obviously that's going to be a pain point for some investors. The other issue here is that they are heavily reliant on growth. We saw the stock chart not too long ago where they had an 82% drop off, which of course is from their growth metrics altering with the global macroeconomic situation there. Now, the last thing here that may actually pose a challenge as well as being a pro, which is their increasing subscription fees, right? There's kind of two scenarios that happen here whenever a business does increase subscription fees. Either the consumer feels that there's still value with the product or service, even with the increase to the subscription fees, or number two is it alters their opinion on their product and service. And so they look to alternatives and competitors. And so we've seen this, especially in the streaming business and the streaming wars, quote unquote. And so we'll have to see how the consumers do feel about this increase. Altogether, it does look like there is a price floor in and around this $30 per share figure where the stock has bounced, but altogether for a speculative investment here for Shopify, I'm going to give this business an investment rating of about a 6 at this current point in time, because I do believe it is a medium risk, medium reward type of scenario. In fact, it's probably more like a high reward scenario, just because like we saw from our calculator there, if we do shift into profitability with Shopify and they're able to produce something like $4 billion worth of operating income on an annual basis, we can see the stock actually balloon up past the levels and the all-time high that it was previously at. And sitting at a $43 per share, that would be a massive upside there. But the risks, of course, are there, and the business is not profitable yet. But that's my analysis on today's video. Please let me know what your thoughts are in the comment section below. Also, make sure to like the video and subscribe. And with all that, I'll catch you on the next one.